Helios Technologies, ticker HLIO. They just delivered a massive double beat for their Q2 2026 earnings.
I mean, truly a textbook quarter.
Right, so let's get straight into the headline numbers. Revenue came in at $231.9 million.
Which is up 9% year over year.
Exactly, and that comfortably beats the consensus estimate of about $230.5 million. But the bottom line, that's where the real shocker is.
Yeah, the EPS numbers were huge.
Adjusted diluted EPS came in at 88 cents. That's a 49% year-over-year explosion, just completely crushing the 80-cent consensus.
And, their GAAP EPS was 66 cents, so really solid all around.
It gets better. Management didn't just beat the quarter, they actually raised the full year 2026 outlook. Revenue is now pegged at $880 to $900 million.
Right, and they bumped up adjusted EPS to a range of 3.05 to 3.25.
Even the Q3 guide came in hot, above consensus. So beat on top, beat on bottom, raise the year. You'd expect the stock to just take off. Right?
You really would.
But the reaction was completely muted. It hovered around 81 bucks a share and actually traded down slightly, like 0.2 to 2.4% right after the report.
It's kind of the ultimate market paradox. I mean, you're staring at an industrial components manufacturer posting record operating cash flow.
Yeah.
Right. They're guiding toward their highest implied annual sales in company history. And Wall Street is basically stifling a yawn.
Which is exactly the mission for this deep dive, because if you're looking at this, you're seeing a company firing on all cylinders on paper.
Right. On paper, it looks flawless.
So we need to unpack exactly what's driving these numbers. We're going to look under the hood at their segment performance and really try to figure out if Wall Street's caution is justified or, if there's a massive opportunity just hiding in plain sight here.
Yeah. And to solve that, we have to start by dissecting that top-line revenue beat. Because a 9% consolidated growth rate, it hides a lot of the actual mechanics happening on the factory floor.
Right. We need to look at the two primary engines, hydraulics and electronics.
Exactly. And honestly, that headline number is a bit of an illusion. When you dig into the hydraulics segment, they posted $146.4 million in sales.
Which, on a reported basis, looks like, what, a modest 4% increase?
Yeah, just 4%. But the metric that actually tells the story of the core business is their pro forma growth.
Yeah.
And that came in at a massive 14%.
Okay, wait, let's translate that for the listener really quick, because pro forma can sound like just accounting jargon.
Oh, absolutely.
Essentially, we're stripping out the noise to get an apples-to-apples comparison. Helios recently sold off a division called Custom Fluid Power.
Right.
And when you divest a piece of your business, your overall reported revenue naturally shrinks because those sales are just gone.
Right. Those revenues literally just walk out the door.
So to see how the remaining business is actually performing, we look at the pro forma numbers and a 14% growth rate in core hydraulics. I mean, that is serious volume.
It really is. It shows that the underlying engine is running hot. I mean, they saw notable strength across the Americas, the EME region, and APAC markets.
Oh, wow. So pretty broad-based geographically.
Exactly. And the growth was heavily concentrated in the construction and agriculture markets. And, those are heavy capital-intensive sectors. So when construction and ag are buying hydraulic components at a 14% higher clip, it means real-world infrastructure and farming projects are moving forward globally.
Right. Then we flip over to the electronics segment. They brought in $85.5 million. And again, that pro forma metric is the key here.
Yeah, totally.
Because we're looking at a 19% organic jump. But the thing that fascinated me in the sources, there was this intense internal tug of war within that segment.
Oh, yeah, the marine weakness.
Right. They experienced demonstrable weakness in their core marine markets this quarter. And usually, if a primary end market like boating and marine equipment takes a hit, it just drags the whole segment down.
In previous cycles, it absolutely would have. I mean, the fact that it didn't is just proof that their strategic diversification is actually paying off.
Interesting. So what else are they doing in electronics?
Well, they've been actively expanding that portfolio into recreational markets, health and wellness, mobile, and just broader industrial applications. Yeah. We're talking about the controllers, the displays, the power management systems inside those products.
Right, the brains of the machines.
Exactly. And because they have their tentacles in all those other growing sectors, they completely absorb the blow from the marine softness and still manage to post nearly 20% pro forma growth.
So to kind of summarize that top line, the 9% reported growth is really masking a 16% consolidated pro forma growth rate.
Spot on.
The core business is genuinely taking market share, But, I mean, you can drive all the top-line volume you want by slashing prices,
Mm.
right? Or by running really inefficient factory shifts.
Yeah, top line is just vanity if you don't keep any of it.
Exactly. So to see if this growth is actually healthy, we have to look at the margins. Did they hold up?
They didn't just hold up, they expanded significantly. I mean, gross
Mhm.
profit jumped 19% to 80.2 million.
Wow.
But the standout metric is the gross margin itself. It expanded by a massive 280 basis points to reach 34.6%.
280 basis points. That's huge for a manufacturer.
It is. And that marks the fourth consecutive quarter of year-over-year margin improvement. And that efficiency cascaded right down the income statement.
Right, the EBITDA.
Yeah, adjusted EBITDA hit 49.3 million. And the margins crossed that critical 20% threshold, landing at 21.2%, again for the fourth straight quarter.
Okay, but I do want to throw a slight caution flag on the play here.
Okay, fair.
Because buried in that gross profit number is a $1 million benefit from net IEPA tariff refunds, essentially trade-related government refunds.
Right, right.
And to me, that feels a bit like finding a $20 bill in your winter coat. I mean, it's nice, but you can't really build a financial model around it.
No, you can't.
So how much of this margin boost is actual sustainable business improvement, and how much is just a one-off from things like that tariff refund?
Well, the $1 million tariff refund is definitely a one-off tailwind, but honestly, it's a drop in the bucket compared to the structural changes driving the broader margin expansion.
Okay, so what's the structural change?
CEO Sean Bagan made a really pointed comment during the earnings call. He stated that the business has officially exited its stabilization phase.
Stabilization phase. That implies there was a period of painful, expensive restructuring happening behind the scenes, doesn't it?
Exactly. Over the last couple of years, they've poured heavy capital investments into shifting their manufacturing footprint.
Okay. Shifting it where?
They moved significant operations to low-cost manufacturing centers in Mexico, India, and China. And at the same time, they aggressively integrated more automation into their legacy facilities.
Oh, I see. So there was a lot of upfront cost.
Yeah, when you're doing that, your costs go up temporarily. You're building new plants, training new workforces, testing new robots. But once those facilities are operational, your baseline cost to produce a single hydraulic valve or electronic display drops permanently.
It's like running a freight train, right? The cost to run the engine and pay the conductor is exactly the same, whether the train is half empty or fully loaded.
That's a great way to look at it.
Because Helios drove up their pro forma volume by 16%, they packed way more freight onto a train that now costs them less to operate, thanks to Mexico, India, and the automation. So every extra dollar of revenue just drops straight to the bottom line.
Pure operating leverage.
Pure operating leverage.
And that structural profitability directly feeds the balance sheet, which kind of brings us to how Helios is generating and deploying its cash.
Which was a record, right?
Yeah. They generated a Q2 record of $42 million in operating cash flow, alongside $31 million in free cash flow. That is a massive amount of liquidity pumping through the system for an industrial company of this size.
And they put that liquidity to work immediately. They reduced their net debt down to $263.5 million. But the ratio that should make any investor sit up in their chair, the net debt to adjusted EBITDA leverage ratio,
So this is the best part.
it plummeted to 1.4x. Just a year ago, they were sitting at 2.6x. And what's wild about that 1.4x number is that it's now actually below management's own stated target range of 1.5 to 2.5x.
Yeah, and a rapid deleveraging cycle like that gives a management team incredible optionality.
Right, because they aren't choked by debt.
Exactly. They aren't burdened by crushing interest payments, and they have the flexibility to reward shareholders while they optimize the business.
And they did reward them. They paid their 118th consecutive quarterly dividend at 12 cents a share.
And they actively repurchased $6 million in stock during Q2, which brings their year-to-date buyback total to $10.6 million.
But wait, when a company's leverage drops below their own target floor, it is a glaring signal to the market.
Oh, absolutely.
Because a balance sheet that clean usually means one of two things, right? Either management is terrified of a looming macroeconomic recession and they're building a defensive bunker to survive a crash, or they're aggressively loading the war chest for mergers and acquisitions.
Right.
Which one is it here? Are they terrified or are they going shopping?
Management's commentary points heavily toward the war chest scenario. They explicitly confirmed a more active M&A posture on the earnings call.
Really?
Yeah, I mean, when your leverage is at multi-year lows and your free cash flow is hitting quarterly records, you have the dry powder to pursue strategic acquisitions without overextending the company.
But they can't just buy growth for the sake of buying growth. I mean, the market severely punishes sloppy acquisitions.
And management was very quick to add caveats there. Any acquisition target must fit seamlessly into the existing hydraulics or electronics portfolio. But more importantly, they intend to maintain a strict ROIC-focused approach.
Return on invested capital. Meaning, for every dollar they spend buying a new company, they have a strict threshold for how much profit that new asset needs to generate.
Correct. They are not going to overpay just to inflate their top-line revenue. They will weigh every potential acquisition against the guaranteed return of just buying back their own stock.
Oh, I see. So if the company they're looking at isn't a better deal than their own stock, they walk away.
Exactly. If an M&A target can't beat the return of a share repurchase, they simply won't pull the trigger.
Okay, so let's summarize the chessboard right now. We have a clean balance sheet. We have optimized structural margins. We have a core business taking market share despite isolated weakness in marine.
Right. All green lights.
That all sounds like a massive victory. Which brings us right back to the central mystery we opened with. Why didn't the stock pop?
Yeah.
The answer has to lie in the valuation and what management is pitching as their next big growth engine. Because the stock is currently trading at a premium, the PE multiple is hovering somewhere around 38 to 44x, depending on which trailing metric you use.
And a 40x multiple is incredibly rich for a legacy industrial components maker.
Yeah, it's tech-level valuation.
Right. Investors paying that price aren't buying past performance. They are paying for a massive future catalyst. And management highlighted exactly what they believe that catalyst is.
And what's that?
A huge new opportunity in data center thermal management couplings. CEO Sean Biggin called this the single largest opportunity across Helios today.
Okay, pause. We need to talk about AI washing for a second.
Oh, yeah.
Because that's when a company just slaps the word AI or data center onto their earnings call to juice their stock price, even if their core product has absolutely nothing to do with tech.
It happens all the time.
Right. So when Helios, a company historically known for building, hydraulic valves for tractors and electronic displays for boats, suddenly claims the biggest opportunity is data center cooling, you have to raise an eyebrow.
Sure.
Is this genuine innovation, or are they just AI washing a rich multiple to keep the market happy?
It's a really healthy skepticism, but the engineering reality here is genuine.
Okay.
Think about the physical infrastructure of the AI boom. High-performance computing and AI servers run incredibly hot.
Oh, yeah, like melt the servers hot.
Exactly. Traditional air cooling in data centers is no longer sufficient to keep these massive server racks from literally melting down. So the industry is rapidly shifting to liquid cooling systems.
And liquid cooling requires fluid power dynamics. It requires precision plumbing, basically.
Exactly. You are pumping coolant through server racks that cost millions of dollars. You cannot afford a leak, a pressure drop, or a faulty valve.
Right, one leak and you fry $1 million NVIDIA rack.
Exactly. So Helios is taking their decades of expertise in high-pressure hydraulics and precision fluid power, and they're engineering the highly specific couplings required for these liquid cooling systems.
Wow, okay.
So it's not vaporware. It is a highly engineered hardware solution for a booming sector.
But, and there is a massive catch here. Management expects the revenue from these data center couplings to begin in 2027.
Yes, 2027.
That means there is zero data center revenue baked into their raised 2026 guidance. It is entirely a future-looking catalyst. You are asking retail investors to pay nearly 40 times earnings today for cash flow that won't start arriving for another year or more.
And that is precisely why the stock reaction was muted.
It's a show-me market.
It's a classic show-me dynamic. To justify a 40x multiple today while waiting for a 2027 catalyst, the core business has to be utterly bulletproof in the interim. Helios cannot afford a single misstep between now and then.
And the immediate future isn't exactly a cakewalk, is it?
No, not at all.
The second half of 2026 features much tougher year-over-year comparisons, specifically in the electronics segment, just due to how their growth was timed in the back half of 2025. Plus, management themselves flagged several ongoing macro risks.
Yeah, they're navigating geopolitical uncertainty, lingering supply chain tariff dynamics, and just the broader unpredictable impacts of inflation on their industrial end markets.
Right.
So investors are acknowledging the fantastic Q2 numbers, but at this valuation, perfection is already priced in.
Okay, that makes sense.
The market is effectively saying, we hear your pitch on the 2027 data center opportunity, and we believe the engineering is real. But you still have to deliver the second half of 2026 without a single hitch before we bid this stock any higher.
So if we look at the big picture, we have an industrial company executing a textbook operational turnaround, optimizing their manufacturing footprint in Mexico and India, deleveraging their balance sheet below their own targets, and pivoting their legacy engineering toward the hottest sector in the global economy, AI data centers.
Exactly.
But they are priced for perfection in a macro environment that is anything but perfect. So, what does this all mean for the listener tracking this stock?
It leaves you with a fascinating thread to pull on. You need to watch closely how the broader market begins to reprice traditional legacy industrial companies that successfully pivot into the data center supply chain.
Because they won't be the only ones.
Exactly. If liquid cooling in data centers becomes as massive as management thinks, Helios won't be the only industrial player making this leap.
Right.
You have to ask yourself a fundamental question. If they capture a meaningful share of the thermal management market in 2027, will Wall Street continue to value them as a cyclical industrial hydraulics company? Or will they be re-rated as a tech-adjacent hardware play?
That's a huge distinction.
Because those two profiles command vastly different multiples, and a 40 might PE might actually look cheap if they successfully transition into the latter.
That is wild. And here is something else to chew on for everyone listening. If precision fluid power really does become the bottleneck for building the next generation of AI data centers, keep an eye out to see if massive tech companies just start buying up legacy hydraulic and plumbing companies outright to secure their supply chains.
It wouldn't surprise me at all.
Right. I mean, the industrial landscape is shifting fast. Keep a close eye on Helios's Q3 and Q4 execution to see if the core business holds the line while that 2027 catalyst develops. Make sure to follow the show for daily, no-nonsense earnings coverage just like this. We will catch you on the next deep dive.